we got to think about December trading, which tends to be quiet towards the end of the year, just in time for the Santa Claus rally, with a few exceptions. And on today's Stocks in Translation, we break down how stocks tend to trade in the last month of the year to help get your portfolio ready for 2026. First, let's take a look at how the S&P 500 index tends to perform in each month of the year. So there you go, 12 months, 12 bars there. The only down month here, and this is going back to 1990, tends to be September. And I'm using the median, which is kind of like the average, going all the way back to 1990. Now here's December, and you can see it's a little bit less than November, which happens to be the best month of the year. That's what we're wrapping right now. And it's kind of in the middle of the pack, but nevertheless, it is positive, or it tends to be positive about 80% of the time. So those are pretty good odds that we have with us. Now I want to show you a couple different models that I've been updating this entire year. Now, what is in white here is what has actually happened. And the first thing you notice is there's that big post-Liberation Day dip and the blistering rally that we saw off of that. Now I have two different maps in here. The median since 1990, that's the green line. That's basically tracking what I just showed you in that other chart, except this is updated on a day-to-day basis. What you need to focus on here is the month of December. Here's where we are. As we enter December, this just gently drifts up into the end of the year. But I actually have a different model that I have found to be very accurate, not only this year, but the last one. And this is based on the median since 1928. So that's going back a really long time, but it actually doesn't include most years. It only includes the years where we match up perfectly with the day of the week. And so what this is saying is we tend to get a nice rally into the end of November, which is kind of what we're having right now. And then we take a little bit of a dip into the middle of the month, and then we reaccelerate into new highs into year end. I would separately add that by the work of Almanac Trader, that's Jeff Hirsch, he's a friend of Stocks in Translation. He has also said that when markets are up big, the way they are now, coming into December, we tend to see consolidation for the first half of the month. So we might expect a little bit of sideways, but again, anything can happen because what we call seasonality, those tendencies based on history, well, that only accounts for about 1/3 of price action. Reality, you know, what the catalysts are and what we face on a day-to-day basis, that's at least 2/3. Now, I want to cover another market that's related to all this. This is the VIX Volatility Index. And a quick refresher here, the VIX goes up when stocks go down, for the most part. That's just kind of a loose interpretation there. But the green line is what has happened this year. And again, I'll point out this big post-Liberation Day spike. We haven't seen anything like that in quite some time. And then we had a couple of volatility spikes in October, and then I believe just a few weeks ago. And those were pretty muted. Nevertheless, the white line is the average from 1990, and you can see that after peaking in October, it just kind of gently stair steps down into the end of the year. And that's as traders go on holiday. We don't typically see a lot of volatility. So it would be really unusual, though not unprecedented, to do so. Here are a few final thoughts on December trading. First of all, we have markets, well, they tend to go up or at least sideways as volatility drops. Stocks rarely crash, but 2018, that was a big exception. When we do see big sell-offs at the end of the year, they tend to come at market bottoms and also tops. So that observation actually comes courtesy of Almanac Trader, who also notes that when stocks are up big into the end of the year, as I just noted, we tend to see that consolidation for the first half of the month and then a rally into the second half into the end of the year. Also, although we didn't talk about it today, small caps, they tend to do better than large caps, the S&P 500. And finally, you've probably heard of the Santa Claus rally. It is actually the last 5 trading days of December plus the first 2 of the new year. So that's your start for 2026. And for more portfolio tuning tips and tricks, tune in to the Stocks in Translation podcast. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
I wanted to turbocharge that by discussing 10 stocks of the day. YOLO right for the holidays. For this one, I want to bring in Wedbush Managing Director and Global Head of Tech Research, Dan Ives. Dan kindly slid into my inbox this week with a tidy list of 10 tech stocks you all should own. He also thinks we're not in a bubble. Dan, good to see you, man. It's been a while.
Great to see you.
Good as always, little boss, little F1 driver look. I'm feeling it, man.
Yeah, of course. For Sazi, I'm always going to bring.
You're the man, bro. So you are out with 10 tech stocks to own in the AI revolution. Level set for us, because we've been talking about this AI bubble stuff for about a month. I'm over it. You make a good point that we're not in one. Why is that?
I mean, I just came back from Asia, was there 3 weeks. Demand to supply is 12 to 1 for NVIDIA chips. I mean, we've seen acceleration in terms of demand, well, even over the last 3 months by 30%. Look, it speaks to our view, only 3% of companies in the US have gone down the AI path. Globally, it's less than 1%. Still very early in this AI revolution, but again, it's easy to call it a bubble from 25th floor of a New York City office building or on Metro North, but when you're actually seeing it in the fabs in Taiwan, you have a much different perspective.
And important, I should note, Dan didn't just become an analyst like yesterday. He's been doing this for many years. And you mentioned in this report that you also worked through the 90s, during that tech bubble. What is the difference between today and then late 90s?
Yeah, and me and you've talked. I mean, obviously, we both for decades have been doing this. So look, late 90s, the average tech company is trading at 30 times revenue.
Like Global Crossing, remember Global Crossing?
Today, 27 times earnings. Yeah. That bubble, when we talk about bubble, that was really created by companies that had really minimal business models, PowerPoints. Today, it's big tech, $1 trillion in the balance sheet, 300 to 400 billion of free cash flow. And also, this is a true fourth industrial revolution. The use case on enterprise, it's the future, robotics, autonomous. And that's why I just continue to say this still continues to be, it was 9 p.m., it's now 10:30 p.m. in the AI party that goes to 4 a.m. and the bears watch the party through the windows from the outside.
I want to start, let's go down this list. Let's start with NVIDIA, because you and I have been talking about NVIDIA for years, but you also wrote another note today calling NVIDIA the Rocky Balboa of the AI trade. What is left for NVIDIA to achieve next year, and where does the stock go?
Look, it comes down to the demand to this point has only been U.S. Think about sovereigns, what's happened in Asia, and ultimately what I think we'll be breaking back into the China market with the regulatory. Look, I think NVIDIA earnings numbers, they're underestimated probably 15-20% over the next year.
Is that mostly because of China?
I think it's China, but also I think it's just the overall demand in the U.S. Now, look, even though on the Google TPU, worries about Tommy Gunn or whatever you want to say, Drago coming to get Rocky Balboa, just to continue with the thesis.
I love Rocky V, Dan. It gets a lot of crap, but that's a good movie.
But I'm actually more bullish on Rocky 2.
Rocky 2, okay, fair enough.
But look, the reality is that there's one chip in the world fueling the AI revolution, and that's the godfather of AI, Jensen, NVIDIA. But look, demand and supply is 12 to 1. Meta, they can't get all the chips they want from NVIDIA.
As someone that has been very right on NVIDIA, very early on NVIDIA, is it laughable to you that Google is now getting some attention with its chips that it's been making, and suddenly we all supposed to care about them?
Look, I mean, it's part of the reason, we've been so bullish on Alphabet or Google just because my view, you start off the year, New York City cab drivers bearish on Google, right? Given DOJ, breakup, AI is going to ruin their business model. But it shows now, they're getting major mojo. But this is just another additional sort of catalyst for them. But I continue to view, NVIDIA 250 continues to be my view where that thing ends a year from now.
NVIDIA, and then let's hit up Palantir. We just had Alex Karp at our Invest event, and he made, obviously, he's co-founder of this company, he made a strong case for Palantir. What's your case for Palantir?
It's the Messi of AI. Look, it just comes down to this is a company that when it comes to use cases, no one could compete. Now you could say it started off on the government side, but for all the work that we've done, that's why there's a name like the haters, they hated it, 12, despise it, 50, yelling from the mountaintops at 100. It continues to be, in my view, what's going to be $1 trillion company next 2 or 3 years. Now look, is it super expensive today? Of course. But what happens when commercial bookings is 5x from where they are today?
And then let's hit another one, Tesla. Elon Musk signed, sealed, and delivered. He's got his pay package. What does next year hold for them? And are robo-taxis, that rollout next year, the main driver of the stock?
Biggest chapter of growth ever in its history. It's about robotics. It's about autonomous. Musk now wartime CEO. And I continue to view, base case $600, bull case $800. They are going into what I believe, when it comes to AI, physical AI, 2 best companies in the world, it's NVIDIA.
Are they a car company?
And Tesla. They're not. Look, I think it's almost offensive to call them a car company because I view them as just a pure technology company. I think investors continue to underestimate what that's going to look like.
Not on your list. I wanted to, before we wrap this up, a couple names not on your list that surprised. Salesforce? not on your list. Amazon, not on your list. IBM, some of these old school companies. Like, why wouldn't they make this?
And those are all in our IVES AI 30 in the ETF. But I'm looking at and those are names that we're very positive on in terms of where they're going to go. What Arvin and Benioff are doing. But this comes down to these are our top 10. These are the elite, right? I mean, these are the names that I kind of view each in its own category, are really, really defining the AI revolution. Salesforce, obviously back against the wall, everything Benioff's doing, I think they're going to be successful. What Arvin's doing, taking a page out of really Nadella's playbook in terms of what they're doing at IBM.
Any chance in hell for Intel now that it's backed by the government? And NVIDIA.
And NVIDIA. I mean, look, you're popping champagne going Thanksgiving as an Intel shareholder, and you have to give them credit, right? I mean, they are now part of the AI revolution, given NVIDIA, given the Beltway, and now it's still uphill battle in terms of innovation, but they're in a much different situation than where they were a year ago.
Lastly, Dan, how concerned are you on how entrenched OpenAI is really to this entire ecosystem?
It's like having too much Peter Luger steak. I don't
I love Peter Luger, man, but I guess that's your point.
The point is it's not a bad thing. Even though Oracle, Microsoft, they're foundational to what they're doing. And I get the words circular deals. Yeah. That to me, they continue to be foundational to where I view the AI revolution. So I don't view anything that's negative, because it's my view, we are still top of the third, one out in terms of this AI game.
Are you the big steak guy, Peter Luger? Are you that guy? I mean, do you share your steak?
No, I share the steak, and I'm not I'm sort of middle of the table type guy. But some good wine. But again, would I rather be Peter Luger's, or I'd rather be in the White Castle sort of drive through 4 a.m.
Good to see you, man.
Great.
The bull market just hit its 3-year anniversary, and historically, you say that is a positive milestone. So let's start there. I'll double barrel this one.
Sure.
One, just walk me through that. Explain that. Why is that a positive milestone? And two, I guess, Kevin, if I'm an investor, I hear that and I wonder, okay, so what are some big risks that could maybe break that pattern?
Yeah, anytime I see a significant milestone like that reached in the market, Josh, I turn to my research team in New Jersey and I say, is this a good sign that better days are possibly ahead? Or is this a sign that the best days were behind us? In this case, it appears as though it was the former, as they were able to go back 50 years and actually see that there's been 5 previous times when a bull market has reached its 3-year anniversary. And in all 5 times, it continued to move higher by an average total duration of 8 years, which would suggest we got 5 more years to go. The shortest duration was 5 years, which would suggest we have 2 more years to go. And in 2 cases, we hit double digits in terms of total years of that bull market run. Now, of course, this time could be different. Past performance isn't indicative of future results. We know all of that. But there does seem to be multiple tailwinds that would support the markets moving higher. But I still contend that the areas of the market that led the first 3 years may very well not be the areas that lead the next 3 years.
Can I ask you, in terms of risks though, all right, history suggests positive milestones.
Yes.
What would be on Kevin's wall of worry there?
I think there's multiple walls of worry, and I don't subscribe to the AI bubble is about to burst camp. In fact, I think those investors who are fearful of an imminent bursting of the AI bubble, that fear is either misplaced, premature, or potentially even both. And if you're waiting for that bubble to burst, you're likely to miss out on the most significant returns that the AI revolution may have to offer. But the risks to me are, what does the Federal Reserve do or not do with respect to interest rates? Ultimately, what happens with US-China trade policy, and of course, valuations. Valuations remain stretched right now, and the money keeps going into the areas of the market that are the most stretched in terms of valuations. So I look beyond that. I look to areas like industrials, utilities, maybe some communication services name as well, because they're all part of the AI revolution, and they're not as stretched in some places in terms of valuations as some of the semiconductors and chip plays.
On AI, Kevin, I know you're in the camp that says, okay, this looks to you like early innings.
Yes.
Another strategist said, forget early innings. We're not even at the plate yet.
Batting practice, that's me.
Okay, let me ask you though, what to that point though, my friend, what are, as an investor, what are the signals that you looked at that tell you this is early, not peaking?
Sure. So what I look to is Jensen Huang. the godfather of AI, the CEO of NVIDIA, what he told us is that he believes there'll be somewhere between $3 to $4 trillion with the T spent on AI infrastructure investment by the end of this decade. So if we're at about $700 billion right now, to get to $3 to $4 trillion in the next 4 years, that's a lot of spending that's coming down the road. And where's that spending going to go? In the batting practice, the infrastructure build, the data centers, the power solutions, the cooling solutions. Not necessarily the AI algorithms and the hardware and the software plays. That's going to come when we start playing the games. And that ROI, Josh, won't be reached for years to come. So investors are going to have to be patient on that front and try and identify more winners than losers in building a diversified portfolio. But for now, the infrastructure play continues.
In some of those big tech AI plays, Kevin, we were talking off camera about this. Some of the divergences are really interesting. If you look in, for example, the past month, Alphabet's a rocket ship.
Yes.
But Meta's been whacked.
Yep.
Oracle's been whacked. And I'm wondering if that tells you what it tells you. Do you think that tells you, indicates to you, okay, investors are starting to draw harder lines here?
Absolutely. I think investors are trying to pick the winners now. And what they need to realize is that the AI revolution is going to be a very long road filled with many potholes. And like previous industrial revolutions, there'll be more losers than there will be winners. I think the losers, though, will be defined as those who either overspend or underspend. And the circular financing that's taking place within the world of technology right now truly is a survival of the fittest because they don't want to be left behind. But the best way to ride this AI revolution, I believe, is to make investments all across the AI ecosystem, including, as I said earlier, the data centers. How about the utility companies that are supplying the power to these data centers? The nuclear evolution that we're seeing, whether through small modular reactors or nuclear power plants. Build them all into your portfolio, incorporating power solutions and the AI ecosystem, and I think you'll find they have a higher likelihood of finding the winners and avoiding some of those losers.
I want to get you on the Fed.
Yep.
Here's what's interesting. So we have the meeting next month.
Yep.
And we had questions about whether there was going to be a cut. It becomes a coin toss, and all of a sudden we see these jitters in the market. Now odds go up, we think of a cut, and I've got green everywhere. Does that suggest to you that maybe we do need a cut for this market to move higher?
It suggests to me that the market wants a cut, and if we don't
Wants,
get that
but
cut,
does it need?
Wants but doesn't need. Now there's a 71% probability of a rate cut in December. If the market doesn't get that, we could sell off. But I think any potential sell-off because of the Fed not cutting is going to be greeted by more cash coming off the sidelines and likely running into those same areas of the market that have driven the market higher, and then we get a strong close to this year.
Finally, let's give the people some picks here, Kevin.
Let's go.
All right, Vertiv,
Yep.
Next Era, Olema Pharma, Aero Environment. Are there certain common themes
Yes.
there in terms of fundamentals or business models that tie those together?
Yeah, my theme for the balance of 2025 into 2026 is follow the money. Where is all the spending taking place? We know it's taking place with respect to AI infrastructure. There's Vertiv Holdings. They supply the cooling solutions to the data centers. We know it's taking place with respect to power solutions. We heard that the U.S. government is looking to buy 10 nuclear power plants. How about NextEra Energy? They own FP&L, and they actually own 5 different nuclear power plants themselves. Biotech, we continue to see more and more M&A activity taking place as it relates to large cap pharma buying small cap biotech. How about a company like Olema Pharmaceuticals, which is focusing on breast cancer treatments with 2 drugs in the FDA approval pipeline. And then lastly, as it relates to aerospace and defense, trillions of dollars to be spent on defense across the globe over the upcoming years. Aero environment, unmanned, autonomous aircraft seems to be the wave of the future, and that's an area that we like as well.
Kevin, always great seeing you, especially on set.
Josh.
Thank you, my friend.
My pleasure. Happy Thanksgiving.
You too.
It's that time of year when everybody's hunting doorbusters and bargains, but while you're fighting for half-price air fryers, there is another clearance aisle hiding in plain sight. That's going to be value stocks. And that's what we're digging into on today's Stocks in Translation. Cheap names with real earnings power, showing you how to build your own holiday stock shopping list with the Yahoo Finance data and tools. Let's start with what a value stock is. It's a stock priced low versus its earnings, its assets, or its cash flow, leaving room for upside if expectations improve. Think of it as a good jacket on the sale racket. Nothing wrong with the fabric, it's just maybe out of favor or in the wrong size pile. But if the fundamentals hold up, you're basically paying less than full price for the same underlying business. But every sale rack has its studs. And in the stock market, that is called the classic value trap. Now, that is a stock that looks cheap but keeps falling because their business is deteriorating, and not just because Wall Street sentiment is temporarily negative. Maybe earnings are starting to roll over, maybe the industry is shrinking, or maybe the dividend is about to be cut. On screen, it looks like a steal, but you soon face regret. So be careful, because in stock picking, there are no returns. Now, let's build a shopping list using the Yahoo Finance Screener. You can find a great preset just by searching Yahoo Finance Screener and clicking on Undervalued Growth Stocks. And here we have some of the categories here. Over 100 names are going to pop up in the results. So let's check in on the filters it's using, then we can whittle down that list. So it starts here with a trailing price to equity ratio from 0 to 20. So you're basically paying under $20 for each dollar of last year's profits. It uses the so-called PEG ratio at a setting of below 1, which means that the price is low compared with how fast earnings or profits are growing. It requires earnings per share to be at least 25% above 1 year ago, so we're not buying total laggards. And it limits the baskets to companies listed on the NYSE or the NASDAQ, just the major US exchanges. Now here's the basket that I ended up with, and we're showing year-to-date returns here on this heat map. I took out all the companies under $1 billion in market cap, and I'm looking for companies paying a nice dividend so that you get paid even if the stock price goes nowhere. You can do this by sorting or filtering for forward dividend yield. But always research the dividend situation of a company, because too good to be true usually is. When a stock price gets beaten down, the dividend yield goes up, and it can look huge on the screen. Sometimes it's a real doorbuster, sometimes it's a sign that the market expects a dividend cut. Now, let's take a look at two of the bigger names. Take Pfizer here. It looks like a classic value trap. And I'm going to put this on a 5-year so you can see the performance. This is after its stock COVID business fell off a cliff and the stock price dropped. So it's down 3% this year, and the company still pays a hefty dividend around 6 to 7%. But cash flow is tighter as it spends to rebuild the drug pipeline, which is why the PEG looks weak. It's real income today with real questions about longer-term growth. Then let's take a look at Ford here, which is cyclical value, tied to the US economy with a big sticker yield around 5 to 6%. It pays a regular dividend, but profits are under pressure from EV losses and a choppy auto cycle. And also, guidance has come down. Its negative PEG ratio tells you that Wall Street expect earnings to shrink, not to grow. This is a doorbuster where the yield is real, but the fundamentals, they have to earn it. It's up over 30% this year, but it's still been cut in half from its 2022 all-time highs. So how do you keep your holiday value basket from turning into a bag of returns? Here is what to watch next, and I got a nice little list here for you. First, you want to watch out for earnings results and guidance. Are the profits still growing, or are they starting to roll over? Then look for dividend changes, hikes, pauses, cuts, because the income line is often the first place stress shows up. Next, check in on your basket and how it's doing versus the S&P 500 or the NASDAQ over time. And finally, watch for changes in interest rate expectations and chatter, because shifts in rates can swing the pendulum between value and growth.
Usually at this time of the year, investors expect any market volatility to be swept aside by an incoming Santa Claus rally in December. But 2025 isn't a usual type of year. A soft labor market and sticky inflation are two factors that could cause Santa to take a detour and skip the usual December bounce. Joining me, Omar Aguilar, Schwab Asset Management CEO and CIO, and Amy Wu Silverman, RBC Capital Markets Head of Derivative Strategy. Thanks to you both for being here. Amy, I'm going to start with you because I know that you watch volatility very closely. We've been seeing an uptick in volatility recently. How do we know if it's going to stick around into December and make December unusual?
Yeah, it's interesting because seasonally, when we hit Thanksgiving, then volatility starts to slow down a little. You get that grind, and then you get that Santa rally. You know, Julie, if you look at all the months this year, none of them have behaved the way they have seasonally. And I kind of expect that to continue because we're actually seeing in the options market a pretty big increase in bearish sentiment that tells me that investors are starting to think more about hedges. And frankly, they start to work a little bit more, which has increased the demand on the downside. So I don't know if we'll get that Santa rally, but we'll definitely get perhaps another volatility pothole or a rally in volatility.
Omar, what do you think? Do you see also that there are some sort of fundamental speed bumps maybe between now and the end of the year?
Yes, we see a lot of dispersion and a lot of discrepancy across many things. On one hand, we're getting new economic data. So at the macro level, we're starting to just get data that we didn't have for several weeks. And that's sort of been absorbed by the market, and that has created volatility. We have seen parts of the beginning of unwinding of that momentum trade that we have talked about since April, and that has put areas that have been done very well this year to start losing some performance. So we see some of those fundamentals going into there, and the opportunities for a catalyst that will propel the market up don't seem to be that strong this time. Maybe the Fed cutting rates will probably put that extra piece to just get the market going, but it's still unclear that will happen in December.
Omar, any other catalysts upcoming either between now and the end of the year, or early into next year, that could be positive for stocks or negative? Or what are the big events that you've got your eye on?
Well, as I said, the first one starts with the Fed. And I think within the Fed is not a foregone conclusion that there will be a Fed cut because there is discrepancy within the Fed members and the committee from, on one hand, the discussion and the discrepancies between what we have on a sticky inflation and a potential softer labor market. And those two seem to be collapsing. And then that created that. Now, if they were to go and create, and today the probability of a Fed cut is up to 70%. And it just happened, to go from 40% to 70% over the weekend. That actually could provide a catalyst. The second one is the continuation of a confirmation that the AI capital expenditures continue to grow. And I think that if you can start seeing signs that there are potentials for that AI return on investments to start consolidating, that could also be another catalyst. And of course, in this part of the year, seasonality will play put a lot of attention on consumer spending, and a big part of how consumer confidence goes into the end of the year will potentially be another catalyst for the market to take off.
What about you, Amy? As you look into December, specifically about the Fed and the possibility of a rate cut or not, how are you thinking about that, and what are you seeing in terms of what's being priced into the market here?
Yeah, clearly a lot of what's been going on in the market has been highly correlated to the Fed. And, when you looked at that December pricing and it looked like we weren't going to get it, we got that tantrum, and then Williams comes out and says something, and, the toddler's a little bit relieved. I would add one thing prior to the Fed that I think is going to be very important, which is actually Oracle, because of so much of the credit issuance you've seen. You've seen this huge divergence between what we see in the credit markets in terms of spreads widening and actually equity volatility not catching up. So I think, one, that'll be important as a catalyst. And then two, obviously the Fed decision. But beyond that, also who the next Fed chair will be and how amenable that Fed chair will be compared to Powell to doing something different as we head into 2026, Julie.
Something I know that you are also watching, Amy, is sort of the right tail. What do you mean by the right tail, and how's that playing into the market environment right now?
This has been such a huge change in our markets because I would say most of the time investors worry about what can go wrong, and they've really had to worry in 2025 about how much can go right. And the reason is you've got this heavily concentrated market. You get a little bit of FOMO and YOLO, and you have investors who can't risk being underperforming their benchmark by a substantial amount. And so we really seen these up crashes where investors are piling into call options. Retail is a big element of that. And the fear of missing out and the fear of, again, dragging that benchmark has been just as important as the other way around. What we're actually seeing now, Julie, is a normalization of that, because this whole year has really been about that right tail being risky. We're finally starting to see machinations that maybe the left tail is important as well, and we shouldn't ignore it.
So, Omar, if we put all this together and we look at the dominance of the AI trade and what we've been seeing thus far, and Amy, your point about Oracle earnings being an important catalyst is well taken. We'll definitely be watching that when it's due on December 8th. Omar, what are you recommending that clients do with these AI stocks right now?
Rebalance. This is the time for many reasons, from tax efficiency to just risk assessment, to risk budgeting. We always encourage our clients to look at these opportunities when volatility is high, to basically find the opportunities to recalibrate their portfolio and position it, for next year. Whether it's equities, fixed income, or just overall, their entire structure of how they want to position their portfolio with their investment objectives, this is the right time to do it. When you think about the prospects of going forward, starting with fixed income, clearly a steepening yield curve will favor for clients to start thinking about the increasing in duration, staying up in quality, because there's really no reason to go into have a heavy credit exposure. But this is a good opportunity when you look at just the results on investment grade these years. They have been great. Those bonds have actually done their job on providing that stability and diversification. So this is the right time, if you don't have enough fixed income exposure, to try to think about it. And then within equities, again, reduction of that momentum exposure when you have areas of technology, a lot of those large caps, a lot of those cryptocurrencies. This is the opportunity to try to deploy assets into areas that haven't done as well. A little more mid cap, small cap, some cyclicals, and then trying to look for what may happen going into next year, mostly related to fundamental and macroeconomic drivers.
And Amy, what about you? Any tips for investors going into the end of the year?
So structurally, we like looking at really expensive stock option premiums on the upside because of that right tail of crash I mentioned, and using it to fund some kind of hedges. Because again, things have done well, and you're really at the point where I think a lot of investors are thinking about their 2026 risk budgets. They're thinking about stocks have done well, and how do I not necessarily take profits, but use those profits and put them in a way that I can also protect the downside.